Golden investment rule: the allegory of turkey traps and the etching lesson in securities investment. If risk management is not known, stock market participation is like playing a game of chance. An old man is trying to catch wild turkeys on the village field. He had a turkey trap, a rudimentary device consisting of a large box with hinged doors at the top. This door is held open with a strut with a pole that extends more than 30 meters to the back of the trap guard. A few grains of corn are sprayed along the way to lure the turkeys into the trap. After getting inside, the guys will find there is more corn in there. When he saw the place where the chickens had entered the trap, the old man would snatch the bar so that the door would fall. Once the door has collapsed, he will not be able to open it up without having to go to the box, and this of course will make the chickens hide outside the fear trap and run away. The time to pull out the bar is when most turkeys get into the trap as expected of the hunter. One day, there were 12 chickens going into his trap. Then one child came out, there were 11 left. That's too much. If only I had to snatch the string when there were 12 left in there, the old man thought. I'll wait another minute, maybe the other one will come back. While the old man was waiting for the 12th turkey to return, 2 more children stepped out of the trap. I should have known to be satisfied with 11 children, thought the trap. As soon as another one comes back, I will snatch the rope. 3 more children came out, and the man was still waiting. Having seen 12 turkeys in his trap, he did not want to go home with less than 8 chickens. He could not give up the thought that some of the original chickens would return. By the time there was only 1 turkey left in the trap, he thought, I will wait until it comes out or another one comes in, then I will return. The remaining solitary turkey rushed in the flock, and the old man returned to his hand. Lesson on tight portfolio management: good control of profit/loss. This is a funny allegory, but every stock investor should pay close attention to avoid it, because the greed meets the empty situation like this. The psychology of ordinary investors is not much different from that of the old turkey trap. They hope more turkeys will return to the box than fear that all the remaining chickens will come out and they will be empty. Relating to the current situation, many investors inherently think that finding profits in the stock market is the most important thing. That concept is true, but not entirely. Besides finding profits, keeping money on the stock market is the most important thing. Because only when you have money will you still have a chance. Losing money is that you lose your chance. Losing all money will mean losing the opportunity. Sometimes we often ask ourselves, is investing simply a cheap buy? It is great if it is always possible to buy one stock at the lowest price and sell that stock while it is price peaking, but it is very difficult to do this often. It can be seen that any investment strategy is difficult to bring about 100% success. Usually, according to statistics, a portfolio with a probability of 70 to 85% of profit has been listed as a portfolio success. Managing the level of stop loss is very important in every hunt to make a profit from investment. It is thought that this simplicity helps individual investors avoid up to 90%. The time to buy stocks in the market sessions is exciting, or even racing under the most exciting stocks in the session. The following concrete example will give investors a more objective view. Case 1. When investing a portfolio with 10 codes, if you want to determine the success of the portfolio is 60%, when you buy 10 CP codes, suppose there are 6 profit codes of 4 loss codes. However, each profit code is only 5% and the loss is up to 10%, so the portfolio still has a loss of 10% across the portfolio. This is a typical case of a successful portfolio, but risk management is not good, so it still falls into a loss. Case 2. When investing a list of 10 codes, if you want the probability of the portfolio to be 40%, then there should be 4 interest codes, with a 10% interest rate/code, and 6 loss codes, but only to stop the stop loss level at 4%. Then summarize the entire portfolio at the right time. Help the example account above example not fall into too serious situation. In fact, cutting losses is never wrong, because if you make a mistake that is not decisive, then the price is much more expensive. When a stock has lost 50% of its value, it must increase to 100% to get capital. Even if a stock loses 75% of its value, it must increase by nearly 300% to return to its original value. In fact, the market to find a stock up to 50 to 100% is very difficult to cover 300%. Therefore, through the above story, we find that if risk management is not known, participation in the stock market is like playing a game of chance. You only really win when you take your profits and cut your losses at the right time so that your total assets after the investment process is greater than your initial investment.